It's John Observation here, and what we are witnessing in the crypto and precious metals markets right now is nothing short of extraordinary. It is unprecedented. Over the past several days, more than $15 trillion has evaporated from gold, silver, and crypto combined. That's right, 15 trillion erased in a matter of hours. To put that into perspective, that's roughly half of the entire GDP of the United States. This is not normal volatility. This is not a correction you see once every decade. This is a system-level stress event, the first true Sigma 10 event in financial history. A Sigma 10 event is so rare that statistically, it shouldn't even occur in the lifetime of the universe. Yet here it is, happening in real time before our eyes. Gold has been hammered down about 15%. Silver has been crushed nearly 38% in this period alone. Crypto has not been spared. Over the last 3 days, over $500 billion has been wiped out of the crypto market. In the last 24 hours alone, more than $2.5 billion in leveraged positions have been liquidated. Bitcoin alone dropped roughly 13%, erasing nearly $265 billion in market capitalization. Ethereum fell about 25%, wiping out over $90 billion, while XRP and Solana crashed 22 to 23%. This is officially the 10th largest crypto liquidation event in history, happening directly after the largest precious metals crash on record. Now, before I go further, for anyone new here, let me be clear. I do not give trading signals, I do not sell mentorships, and I do not run buy or sell alerts. That has never been what this channel is about. This is a space for independent thinkers, people who use this information alongside their own analysis and judgment. We dissect, we connect the dots, and we analyze structural market dynamics. If you're here looking for someone to tell you exactly where to buy or sell, this is not the place for you. Let's rewind a little to Friday when this whole chain reaction began. The metals crash happened first. Silver collapsed more than 30%. Gold lost over 13%. That's roughly $7 trillion erased from precious metals alone. But this wasn't random. This was not just due to dollar strength or macro headlines. It was highly coordinated and leveraged. Here's why. The CME raised margins to 11% on January 28, which forced speculators who had long positions at lower margins to post additional collateral, often double or triple what they initially put in. When silver dropped violently from $120, these over-leveraged positions were liquidated, creating an avalanche of selling. Meanwhile, JP Morgan timed its exit perfectly, closing 633 silver short contracts at the very bottom, buying from forced sellers at the lows, while physical holders in China and India refused to sell at any price. This disconnect between paper and physical markets created the perfect storm. Now crypto entered the same narrative. The crypto markets were already on edge after the metals crash. Bitcoin fell below $79,000. Ethereum, XRP, Solana, all of them faced extreme liquidation waves. There have been 3 distinct waves over the last 12 hours, totaling approximately $1.3 billion in liquidations. This happens when liquidity is thin and leverage is extreme. In a highly leveraged market, a small imbalance triggers cascading liquidations. Herd sentiment swings violently between extreme bullishness and extreme bearishness, which creates air pockets in price, making the crashes steeper and the rebounds sharper. One key point here is Michael Saylor's Bitcoin holdings. His strategy holds 712,647 BTC, acquired at an average price of about $76,038. At the market peak of $126,000, his holdings were worth roughly $81 billion, even though he had fewer coins than today. If Bitcoin drops below $74,600, Saylor goes underwater. That's not just a number. It's a psychological line in the sand for crypto markets. Headlines about positions like this amplify fear, accelerate margin calls, and push weaker hands into panic selling. The connection here is simple. While $15 trillion were being erased from metals and crypto, the mainstream media was busy flooding the public with Epstein files, war headlines, and World War III narratives. This is the classic distraction technique. While the system is being flushed of weak hands, public attention is elsewhere. The money doesn't vanish, It simply moves into stronger hands. Markets aren't just manipulated, they are rigged, and right now we're seeing it in action. Geopolitical factors are another critical layer. The U.S. has deployed troops and warships amid rising tensions with Iran. Qatar reportedly delivered a final message from the United States to Iran's supreme leader. Any escalation immediately impacts risk appetite. Traders sell first, ask questions later. Meanwhile, the first U.S. bank failure of 2026 occurred over the weekend, the first in more than 7 months. This is eerily similar to 2008. Small banks fail first, contagion spreads, confidence cracks, and system-level stress becomes visible. The system is far more fragile than most people realize. So what about Monday? There are 2 potential scenarios, bearish and bullish. The bearish scenario is straightforward. If this is a liquidity crisis cascading from metals to crypto to equities, Monday could be devastating. Asian markets open first. If China, Japan, and Hong Kong gap down significantly, European and U.S. markets follow. Crypto could see another wave of liquidations as retail wakes up to losses and panics. Margin calls, cascade. If Bitcoin drops further, if Sailor goes underwater, if more banks are rumored to be in trouble, confidence erodes. The flight to cash accelerates. Even safe havens like gold and silver get sold initially, because early-phase crises force all liquid assets to move. Paper markets drop while physical holders remain firm. The bullish scenario is just as plausible. If J.P. Morgan and other major players successfully covered their short positions at the bottom, the next leg up could be explosive. Weak hands are flushed. Physical demand remains tight, particularly in China and India. Shanghai premiums are already above 43%, signaling the disconnection between paper and physical silver. If liquidation pressure ends, if Asian markets stabilize, if geopolitical risks de-escalate, shorts are gone, positions reset, and markets can snap back violently. Crypto could bounce if over-leveraged positions have been liquidated. Confidence returns. Herd sentiment swings from extreme bearishness to cautious optimism. Now, there are specific indicators to watch over the weekend and into Monday. The Shanghai Silver Open. If it holds or rises while COMEX remains closed, physical buyers are not panicking. Bitcoin over the weekend, if it stabilizes at $79,000 and potentially bounces to $82,000, $85,000, that's bullish. Iran news. Any escalation is bearish, any diplomatic progress is bullish. Bank headlines. If Metropolitan Capital was an isolated case, confidence holds. If more banks are rumored to be in trouble, panic spreads. So 3 key takeaways. First, this was not normal market behavior. $15 trillion erased. Largest metals crash ever. 10th largest crypto liquidation ever. System-level stress, clearly visible. Second, physical versus paper disconnect is extreme. Premiums are exploding. Physical holders refuse to sell. Third, multiple catalysts converging, bank failures, extreme leverage, geopolitical tensions, obvious market manipulation. Monday could either mark the end of a planned flush or the beginning of something much larger. The unresolved question remains. Was this weekend the final shakeout before the next major bull run, or is it the opening act of a broader systemic crisis? Evidence suggests J.P. Morgan and other large players timed their actions deliberately. Short positions were covered, weak hands flushed, and positioning reset. But $15 trillion erased, ongoing bank fragility, geopolitical risks, and crypto liquidations suggest we could be at the start of something larger. Do your own due diligence. Understand the risks. If you're over-leveraged in metals, crypto, or equities, this environment is unforgiving. Margin calls and forced liquidations do not care about your thesis. But if you're positioned appropriately and you understand what is happening, Monday could be either the opportunity of the year or the start of something much worse. Stay sharp. Watch the data. The next 24 hours will tell us everything. Invest with logic, not hype.